wondered why your favorite NBA team can't just buy all the best players? In today's video, we'll break down the NBA salary cap in the simplest way possible. The NBA is a huge spectacle that keeps on growing. Over the past 20 years, the league's value has ballooned to almost $100 billion, and the average team is now worth over $2 billion. How does the league stay fair and competitive with so much money flying around? What prevents one team from buying its way to success and having all the best players playing against the weaker ones, like we see in some soccer leagues worldwide? The answer is the salary cap. The salary cap, introduced in the 1984-85 season, limits how much teams can spend on player salaries. This promotes competitive balance and financial stability, since teams are less likely to go into debt by offering outrageous deals to sign all the best players. How is the salary cap calculated? It's simple. It's based on the league's income, which includes everything from TV deals to ticket sales, merchandise, and any income generated by the NBA. As the league's revenue grows, so does the salary cap. Players receive around 50% of league income. The NBA salary cap is not the same as the salary cap seen in other American sports like the NFL. The NFL uses a hard salary cap. The NBA uses a soft cap. As a result, by using exceptions, NBA teams can sometimes exceed the salary cap in certain circumstances. As the name suggests, these are exceptions to exceed the salary cap. Using exceptions is very common. One example is the Bird exception, which allows teams to re-sign players who have been with them for some time. Named after NBA legend Larry Bird, it aims to incentivize players to negotiate with their existing team rather than become free agents. Teams can exceed the salary cap to sign a player using the Bird exception. Bird rights transfer to a new team in a trade. To understand further how the salary cap and spending work within the NBA, let's look at the figures for the upcoming 2024-25 season. The current salary cap is set at $141 million. This is the maximum amount a team can spend on total player salaries without using exceptions, like the Bird rights I just mentioned. However, exceptions are still considered regarding the luxury tax. The luxury tax is a system designed to reward teams for staying under a set limit while punishing those that don't. The luxury tax figure for 2024 is $171 million. So, if a team spends over this amount on salaries, including exceptions, they will have to pay even more in luxury tax. Depending on how far past the luxury tax a team goes, they will start encountering aprons. The first apron for 2024-25 will be set at $178 million, after which teams face penalties and trade restrictions, like not being able to sign a player waived during the regular season whose salary was over the mid-level exception, and tighter salary matching restrictions in trades. Surpassing the second apron, which will be set at $189 million, comes with even more penalties and restrictions, like not being able to use the taxpayer mid-level exception or the ability to send out cash during trades. So there are several reasons why teams wouldn't want to spend too much on player salaries. Many player transactions, even basic ones, now automatically create a hard salary cap that teams cannot exceed under any circumstances, regardless of what Bird rights or exceptions they use. For example, if a team acquires a player via an inbound sign and trade or takes back more salary than they're sending out in a trade, they are now hard capped to the first apron. If a team sends cash in a trade, they are hard capped by the second apron. These are just some examples of hard cap triggers, and the following video will go more in depth on this. To get a better idea of how these systems work, consider the Golden State Warriors. In the 2023-24 season, their payroll totaled $181.1 million, and the luxury tax was $165 million. Luxury tax fees escalate based on how much a team exceeds the luxury tax amount set by the NBA. Because Golden State was $16.1 million over the set luxury tax amount, they were forced to pay an additional $48.6 million in fees. Who did they have to pay? Well, that's the genius part. Luxury tax revenue is redistributed evenly to all teams that do not exceed the luxury tax. So the Warriors essentially gave money to their rivals. The first and second aprons are relatively new and were introduced to curb and penalize excessive spending further. In addition to Bird rights, other salary cap exceptions in the NBA include the mid-level exception, or MLE, which teams can use to exceed the cap and add players to their roster. Each team can use one MLE per season. This can be split among multiple players or can be used for a single player. A biannual exception allows teams to sign one or more players to contracts whose first-year salaries add up to no more than $3.382 million combined. This exception cannot be used in consecutive years, hence its name. A team over the salary cap can also sign a player to a minimum salary deal using the minimum salary exception. Teams can use the exception multiple times in a league year, giving clubs that have used all of their cap room and other exceptions an avenue to fill out their rosters. The NBA also allows teams to sign their first-round draft choices to rookie scale contracts, even if their payroll exceeds the salary cap. These measures allow NBA teams some flexibility while keeping the league competitive and entertaining. While the NBA salary cap can be confusing, seeing how teams navigate it is fascinating. Whether they're maneuvering to stay under the cap or choosing to pay the luxury tax, it's always interesting to watch the strategies unfold. Hopefully, this video has helped you understand how the salary cap works. If you have any questions or a topic you'd like me to cover next, let me know by dropping a comment. Don't forget to like the video and subscribe for more basketball knowledge. I'll see you in the next one.